Frequently asked questions. Restrictions on the exchange proceeds. In this segment, we want to look at something that's very important. In a 1031 exchange transaction, the qualified intermediary, while they're holding those proceeds, are subject to certain restrictions. And these are restrictions that are specified in the Treasury regulations that apply to 1031 exchanges. Specifically, this deals with section what is referred to as G6. So it's section 1.1031K-1G6, but oftentimes it's referred to as the G6 restrictions in a 1031 exchange. Under the Treasury regulations, there are requirements that the taxpayer can't receive the proceeds or have access to the proceeds at any time they want while those proceeds are in the possession of the qualified intermediary. So what it states, and you'll see this on the screen literally, is that there have to be stipulations in the exchange agreement that limit the taxpayer's ability to receive, pledge, borrow, or otherwise obtain the benefits of money or other property before the end of the exchange period. Now, the exchanger may have rights to receive, pledge, borrow, or otherwise obtain the benefits of money or other property upon or after certain circumstances that we'll look at. So this is a restriction. What's important in any exchange conceptually is that the qualified intermediary is actually the seller of the relinquished property and the purchaser of the replacement property. And the taxpayer during that exchange time period cannot in any way access the funds. In fact, the wording that you see literally, they can't receive the funds, they can't pledge the funds, they can't borrow against them, or otherwise obtain the benefit of money or other property before the end of the exchange period. So the wording on this is very unambiguous. It's very clear the taxpayer can't have any control of those funds during the exchange period. So more specifically, it says under section G6, the taxpayer can have a right to receive, pledge, borrow, or otherwise obtain benefit of money or the property after certain things happen. And let's look at what the Treasury regulations state. Under section A, the receipt by the taxpayer of all replacement property to which the taxpayer is entitled under the exchange agreement. Take note of the words all replacement property and to which the taxpayer is entitled under the exchange agreement, because we're going to circle back to this in just a moment. Or B, the occurrence after the end of the identification period of a material and substantial contingency that relates to the deferred exchange, is provided for in writing, and is beyond the control of the taxpayer and any disqualified person. So there is an exception B of a material and substantial contingency, but it must relate to the exchange, be provided for in writing, and is beyond the control of the taxpayer. So this states what is permitted. And there's some ambiguity on that. What's a material and substantial contingency? Well, it's very specific. It has to meet these requirements. There are certain things that would probably fit into that, and I could probably come up with scenarios. An easy one that to maybe give an example of this would be, what if the property identified burns down? It certainly is substantial and material. It relates to the exchange and certainly beyond the control of the taxpayer. That might be an example. The point being, under Section B of this, it really has to fit under what the Treasury regulations state. And that probably fits a fairly narrow set of circumstances. But let's look at Section A, because this one's very important. The receipt by the taxpayer of all replacement property to which the taxpayer is entitled under the exchange agreement. Well, we're going to go look on the next slide and kind of go through two different scenarios and what the implications are of this. Scenario number one, a taxpayer in a delayed exchange identifies multiple properties within the identification period. And what they decide is they only want to purchase one of those properties. So let's just say the taxpayer identifies 3 properties. They make the decision they only want to purchase the first property, property A. And in fact, what they want to do is they want to receive the remaining proceeds. They know it'll be taxable boot, but they want to receive those proceeds. Well, if you look back here under Section A, the taxpayer must receive all replacement property they're entitled to. If a taxpayer identifies three properties, then they're entitled to buy three properties within the exchange period. So the money can't be released until they bought all the properties that they're entitled to. So in scenario A, if the taxpayer decides they only want to buy one and receive the excess proceeds as taxable boot, what they want to do within the 45-day identification period is this: unidentify property 2 and property 3. That way they're entitled to buy property 1. Once they buy that property, they bought all the property that they're entitled to under the exchange agreement. They cannot buy any more property. Therefore, the excess proceeds, the remaining boot in the qualified intermediary's account, can be released to the taxpayer. So they'll pay taxes on it, but the intermediary can release it. Let's look at scenario number 2. Same fact pattern. Taxpayer only wants to buy one property, and they want to receive some boot at the end of the exchange. So if they identify three replacement properties under the three property rule, let's say they're on day 63. They buy property A, and they want to receive the remaining proceeds. The qualified intermediary cannot transfer the proceeds back to them. Why? Because under Section A, it says the taxpayer has to receive all replacement property that they're entitled to under the exchange agreement. That taxpayer is entitled to purchase property B and C. The qualified intermediary cannot release the proceeds until day 181, the expiration of the 1031 exchange period, because that taxpayer is entitled to receive those replacement properties because they've identified two more properties. So hopefully that makes sense, and the reason why this is so important is if a taxpayer wants to receive some taxable boot, it's really important that they review their situation both with a knowledgeable qualified intermediary and their tax and legal advisors. Boot can be received from the relinquished property closing, so they can receive some money out, and that's taxable, and the remainder can go to the qualified intermediary. However, once all the money's been transferred to the qualified intermediary, now these G6 restrictions apply, and the taxpayer can't access the money at any time they want. So some comments and concerns that sometimes we hear from taxpayers: well, I'm going to pay taxes anyway. How come you can't give essentially the money you're holding on my behalf back to me? Well, a qualified intermediary can't, because Section G6 of the exchange agreement, which was executed by the taxpayer and the qualified intermediary, states taxpayer has to receive all replacement property that they're entitled to under the exchange agreement. Well, what if properties B and C have been sold to other purchasers? They're no longer on the market. Same fact pattern. They have to receive all replacement property to which the taxpayer is entitled to under the exchange agreement. So the fact that somebody else has bought the properties doesn't mean that the taxpayer is not entitled to buy property B and C. They still are. They could still negotiate and under the Section 1031 rules purchase those properties. So I want to address this in advance. It's important to do advanced planning, to review your scenario in advance, and if you do want some taxable boot, to determine when you want to receive that, either from the sale property closing, or maybe at the end of the exchange, or maybe you don't know. But it's important to be aware of these G6 series restrictions that apply. To review your specific 1031 exchange situation, contact Asset Preservation's headquarters in California at 800-282-1031 or our Eastern Regional Office in New York at 866-394-1031. Please read the full disclaimer, as Asset Preservation cannot provide tax or legal advice.